Important note, the 10-year yield right now at 4.43, easing a bit from where it was, but still pretty close to its highest level since 2007. So I think that's really where we got to start here, Bryn. A lot of disruption ever since Jay Powell indicated higher for longer. Where do you go from here? And I think it's important to note the NASDAQ and the S&P also on a 3-week losing streak as well.
I think you actually have to go a little bit further because July 31st was really the peak in the S&P. And then all of a sudden, the 2-year and the 10-year start moving up. And I think as soon as the 2-year got to 5 and the 10 years hit that 425, all of a sudden equities can't handle that. And so you're seeing really that digestion of higher for longer, which Jay Powell just reiterated. And so I think that ultimately this is going to be settled because typically stocks follow bonds, but right now bonds have been following stocks, and that all year long stocks have said no recession, soft landing, rates are going to cut next year, while bonds have been saying inversion, which means recession, 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 and now bonds are saying, hey, you know what, I think the stock market was right, and so you're getting that uninversion of the bond market. And to me, that's the whole story here, because you really have to re-rate what can multiples be, how high can the stock market go if we're going to continue to have multiples, rates be higher for longer.
Weiss, same question for you. I mean, what's next? We're about to enter Q4 next week. We've had a pretty strong start to the year, but a lot of disruption recently, also some big macro things and some U.S.-specific things like a possible government shutdown, other issues here in the U.S.
Yeah, so what's next is earnings season. And as opposed to the last year or so, expectations are higher. They're more optimistic. So now you've got to actually bridge that optimism with reality. I personally think there's a chance it falls short. Look, I think the market, I've been cautious in the market for a number of weeks, remain very cautious on it. I've trimmed exposure. Here's the issue. I do believe we go into recession. I don't believe there'll be a soft landing. I'm still amazed by some of the lunacy out there that as recently as a month or two ago, some strategists, some whatever money managers are saying the Fed's going to start cutting rates. They're not going to cut rates. They're going to leave rates the way they are. So we've seen a delayed reaction to the massive tightening cycle that we've had. I don't think it gets any better. I think it gets worse. And there are a number of factors. Additionally, inflation is not really under control. Okay, we've had the easy move down from 9% to 3.5%, 4%, pick a number. But guess what? We're poised for it to go higher. Why? Because of energy, because of the UPS strike, because of the UAW strike, because of the Inflation Reduction Act. We haven't even started to deploy capital. Wait till we start doing it. So you've got all the triggers for inflation going higher. So you cannot tolerate rates like that. We're a consumer-driven economy. 2/3 of the economy is driven by consumers. Now you see these cars rolling off leases. So I've had two. Fortunately, I can afford it. But the cost of leasing a car, the cost of buying a car has gone up 20 to 40%. So where do consumers make choices? In addition, you've still seen, while rents may be coming down a little bit in some areas, basically they're still on the rise. So where do you take it from? You got to pay more for energy. Okay, it's not like you've seen grocery prices come down measurably.
Good point.
So it all adds to pressure on the consumer that drives the economy. And guess who's going to pay for the UAW wage increases? You, Bryn, me, Rob. Maybe not Rob because he's America's guest, so who knows? But in general, it comes to the consumer. That further takes wallet share.
So Weiss, to your point, as if we didn't get the message from Jay Powell, Boston Fed President Susan Collins saying today she feels that we need to keep rates higher for longer. She is a voting member this cycle. So I think you're right. The Fed is just trying to make it clear to the market. Whatever you thought was going to happen, we're trying to make it clear.
Right. So final word. Past is not prologue. Okay. Just because the equity market has held these levels for the top line, lots of stocks have suffered, right, doesn't mean that's going to continue to be the case. I believe it's a delayed reaction and the markets go lower. They definitely don't go higher and hit new highs.